I'm Bruno Santos. Thank you for joining us for this fund update with John Moog, the Portfolio Manager for the Pengana Global Smalls Company. John and his team have a unique approach to investing. He'll talk a little about this morning, the type of companies they look for and the process they follow to identify them result in a very differentiated portfolio with different biases and different exposures. What this means is that the performance is expected to be very different, both to the index and in all likelihood to the other holdings in your portfolio. Vaccinations and a milder COVID variant are helping most of the world transition to the stage of living with the disease. Unfortunately, global economies are still suffering the after effects of the pandemic as supply chains remain choked and inflation has taken hold. The investment landscape is further complicated by geopolitical events as one of the world's most important source of natural resources wages war on one of Europe's most important producers of agricultural products. During this morning's update, John will discuss some of the countries and sectors best positioned to weather inflation, the potential safe havens, and how the team is thinking about portfolio construction as globalization falters and the cost of capital continues to rise. John will also discuss some of the interesting holdings within the portfolio. John will be speaking for about 25 minutes and we'll have time for a Q&A at the end. Please enter your questions into the question box, which can be accessed from the bottom of your screen. We'll get to as many as possible at the end. John, over to you.
Hi, good morning, and thanks all for joining me today. My name is John Moog. As mentioned before, I'm the portfolio manager and CIO here at Lizard Investors. And I will be giving you guys a chat about what it is we do, investing in global small companies, a bit about how we invest, where we invest, and why we invest in the companies we invest in. But I would like to spend a majority of the time talking about the current environment, which I think is quite unique for a lot of us in the last 20 years. It's the first time we've seen real inflation in the global environment in quite some time. So I'll be spending a lot of time on the current environment and I think some of the interesting learnings we're having as we talk to management teams about the current environment and how they're navigating the current geopolitical tensions as well as slowing economies with rising inflation. So in terms of who we are and what it is we do, Lizard is a specialist and we only invest in global small companies. We've been doing it since the inception of the firm back in 2008. We launched our first fund January 1st, 2009. The team is made up of 4 investment professionals, and David and myself, David Lee and myself, have been working together back since 2008. So we have quite a bit of experience investing in this niche in the market. We've been operating for the last 14, 15 years now, and I think we bring a good perspective on the ups and downs and what it is and the opportunities that we're experiencing today in the global small company space. What it is you get investing with Lizard, I think I talked about the team. You get an experienced and stable team that's been together since 2008. We have 2 analysts who have both been with us for over 5 years now. We've got a proven process that we think drives quite a bit of alpha over a long-term investment horizon. And we tend to have a concentrated portfolio that is unique and very differentiated relative to the index. We're cash flow based investors. We invest with a 3 to 5 year investment horizon. And again, back to top 10 typically representing about 30 or 40% of the portfolio. It is a high conviction portfolio, which we think is the best way to access the alpha in the small company space. So if you look at small company, global small caps relative to global large caps over time, what you'll find is probably similar to what you'd find in many of the studies you guys look at in terms of large caps versus small caps. Small caps tend to outperform large caps over a pretty wide margin over a long period of time. And they do so with relatively limited increase in volatility. And we think it makes it a really interesting place to be from a portfolio, having an allocation in your portfolio. Obviously, the small caps have underperformed large caps in the more recent period. However, again, on a long-term time horizon, it's not only an excellent diversifier, but generates quite a bit higher absolute return over time. Why we think that's the case and why we think active management is so important in the small cap space is you can see here, there's the universe we invest in is roughly 50,000 companies. So it's a massive universe with a significant portion of the universe being uncovered by analysts. And also the average analyst coverage is only 5 analysts per small cap company that is covered versus 22 for large caps. So we think the opportunity to actually, through fundamental research, identify high quality businesses at very cheap prices really exists in the small cap space in a way that doesn't quite, is no longer the case in large caps and mid caps. So we think, again, fundamental investing is really, the opportunity set for the small cap space for fundamental investing is very attractive and very good. Our philosophy here at Lizard, for those of you who don't know it or haven't heard it before, we believe in the structural inefficiency of small caps. We think that is what we're here to attack and over time deliver returns on. We believe the most important part in terms of capturing the opportunity is to invest in high quality businesses that will compound for us over market cycles. We are fundamental bottoms up investors, and we think the diligence process really uncovers and researches unique opportunities. And we think you need to have a long-term investment horizon investing in this space. And we think it's important to concentrate your capital on your best ideas, especially if you've driven significant research in both sourcing and researching the diligence in these businesses. We want to concentrate our capital on our best ideas. And we think that is really the best way to deliver alpha over a long period of time in the small cap space. The way we define a high quality franchise is fairly straightforward, fairly simple. We want a business that's going to earn high returns on capital over a long period of time. So we want a business that has significant competitive advantages that we can understand that will enable it to really take share and take share with high returns over long periods. We think that's really important for us. That's really the most important thing we look at. We also look for businesses that have strong balance sheets that will be self-funding, both be able to fund their growth, but be able to fund themselves through downturns. The third thing we look for are disciplined and aligned management teams. And what we really mean by that is we like management teams who have significant skin in the game and invest alongside us. The fourth thing we focus on is corporate governance. So we want businesses that have the highest governance standards, that treat minority shareholders as partners, that adhere to all legal and regulatory frameworks, and really have a long-term oriented mentality in terms of operating and governance. And then the fifth thing we look at, again, is kind of that compelling valuation. We want to be paying about half of what we think a business is worth on a 3 to 5 year basis. Those are really the drivers for us of what gets into a portfolio. So now moving on to what we think the current and market environment looks like, what we're seeing and what we're thinking about. Obviously, there's been some fairly large headline issues out there in the world that we're all wrestling with over the last several years. I think a couple of things, I think COVID, as well as the recent Ukraine and Russia war, along with some more aggressive geopolitical behavior in many areas of the world, are making us realize a couple of things. The first step, I think COVID, while has been extremely painful on a personal level for many of us, the secondary point is it's really highlighted the challenges with a just-in-time global supply chain. The recent Shanghai issue, I think, has brought a few industries to their knees in terms of supply chains. We continue to think and we continue to see companies that we talk to, management teams that we speak with, talk about having to really look at their supply chains, potentially carry more inventory and use more near sourcing. And we think that's a really critical change in the way global supply chains work. And that's differing from what we saw 5 years ago when everyone was still very much focused on just in time and lowering their cost of production without any real concern around the security of the supply chain. And I think the second piece that we'd highlight is, the concept that we think this war and aggressive geopolitical behavior from many countries really indicates the beginning of a reversal or a slowdown in globalization. Globalization has been a driver for increased productivity around the world for the last 25 years, specifically with China coming up the industrial production curve. It has really driven lower cost of consumer goods in many places in the world. And now that China is an aging population, and the working age population in China is going to begin declining quite rapidly, we do think the world's going to struggle with less productivity. And we do believe between the supply chain issues and potentially loss of, a potentially more expensive manufacturing environment all over the world, we do think this will create more sustained inflationary pressure beyond what we're seeing right now, which is, in our view, more of a temporary phenomenon. We do think longer term that creates more inflation around the world as people deal with less productivity. So what are we seeing specifically in supply chains? I think this slide is fairly indicative that we're seeing new orders begin to decline as the economy slows, but we're still seeing a problem in terms of slower deliveries. And that's peaked in 2021, but it's still well above trend line in 2022. And so we continue to see problems with really orders being met all over the world. And then on the inflationary front, we really see inflationary spikes in almost every commodity complex we're looking at. And we think we think some of this is temporary phenomenon around the Russia-Ukraine issue. Is Russia and Ukraine, between the two, are obviously critical, both in terms of energy production in terms of oil and natural gas, but also into the wheat complex. And you see that really here, both on food and energy commodities spiking. And so we think some of that is temporary, but again, some of it is going to be longer term and structural, and something I think investors need to think about. And then back to this supply chain issues that we continue to see around COVID. Here, this red line shooting up this graph really shows you what happens when Shanghai shuts down. Is the number of ships waiting to be offloaded at the port in Shanghai spikes massively. And this is, as you can see, this is a massive shipping port that's been brought to its knees. And obviously things are getting back and going in Shanghai. But the issue here becomes when you have a 4-week window of time from getting things from Asia to Europe, or 6 weeks from Asia to the US, this really wreaks havoc with company supply chains. And I think we'll continue to see this until we have until we see less COVID zero policies in many places in the world. So this all rolls up into what we're seeing, which is a significant spike in consumer inflation really all over the world, right? And while we think a lot of this will be brought under some level of control here over the next few quarters, as central banks really all over the world start to tighten. You've seen the US start to tighten. You've seen Europe start to become much more hawkish. We think all of those things will bring inflation back down. But I think moving back below that 2% level we experienced for many years in the last decade, we do think that's going to be more of a challenge moving forward. We would expect longer run inflation to be more in that 3-4% range. And we think that is something investors are starting to try to grasp and get their head around. And we'll talk about some of the implications of that. But we think that's really an important issue that's going on in the capital markets currently as people digest that concept. I think the last piece that we talk about here, and this is specific to the capital markets, is some interesting things, which is the dollar has been very strong against almost every other currency in the world. And while obviously the dollar tends to act countercyclically and is a flight to safety in downturns, which is what we've seen the last 6 months, longer term, what we're seeing is that the dollar is about 20% above purchase price parity, which means roughly it's 20% overvalued against every other, against a basket of other currencies in the world. We think that's a bit unsustainable. And we think as the world starts to move on to looking at growth in 2023, we would expect the dollar to, again, be fairly countercyclical and non-dollar assets to rise in value as people get a little more optimistic about the future than they are right now. So again, dollar is about 20% above purchase price parity. And we think it looks quite overvalued to us. While we're not macro investors, we certainly think investing in non-dollar assets, non-US dollar assets is a good place to be. The second thing, and this is the chart on the right that I think is really astounding, is the difference in valuation between US and non-US equities. And we have the Euro Stock 600 chart up here, but this would look fairly similar if I was looking at really almost any region in the world outside of the US, which is there is a significant gap in valuation between US and non-US stocks, and it's wider than it has historically been. Currently, non-US stocks are trading at about 12 times earnings, with US stocks trading at about 18 times earnings. And that valuation gap is also quite interesting for us. So from our perspective, there's a real opportunity here to look at buying non-US dollar assets at much cheaper valuations. And we'll talk about some of the catalysts of why we think that's an interesting place to be, but also from an absolute return basis, I think you're starting at a much cheaper place buying non-US dollar assets than you are buying US dollar companies at this current point in time based on these two charts. So what are the implications of all this, and what is happening out there in capital markets? And what it would, really, I think as people kind of grasp the investment environment today, we're really thinking out what does the next 5 to 10 years look like for investors? I think the first thing that we think is interesting is that I think over the last 10 years, given a lot of the forced capital allocation through superannuation funds or 401k funds in the US, you've seen the world get just split into some very simple buckets, such as developed versus emerging countries. We think that moving forward, that model is going to be a bit more challenged. We think the differentiation between countries and their ability to really handle a more inflationary environment, those that have resources, those that don't, are going to make the simple differentiation of developed versus emerging not as relevant moving forward. And we think people are going to be forced to really analyze countries and companies more closely and not be able to just lump them all together into some very high-level buckets. And I think it would speak to also, the concept of just being able to invest in passive products that get you, let's say, U.S. allocation or whatever it might be. I think will become a more dangerous place to be as countries and companies really start to diverge in terms of performance on a fundamental level. And I think the second piece, and we think this is really important, and I think we saw this back in 99 and 2000, 2001 when I first started in this industry, which is the cost of capital has gone up meaningfully. We have lived through a 5 to 10 year period, or at least the last 5 years, where the cost of growth capital was extremely cheap. Companies that with unproven track records, with let's say business models that hadn't really been developed yet, have been able to raise capital at very cheap levels to really fund their growth. And that game has ended, and it's ended really quickly. And so we think the continued area of stress in the market is going to be these, let's say, growth capital reliant businesses that need capital to grow, that can't make money, don't generate free cash flow. We continue to think that area of the market is going to be under pressure for a long period of time. We've seen it here in the US in the SPAC market, which funded, I would say, hundreds of billions of dollars of fairly suspect companies. We continue to think that area of the market will be punished, and I don't think that capital is coming back anytime soon. On the flip side, we do think there's a lot of companies out there that don't require a lot of external capital that are now at very cheap prices given the sell-off. And we think that will be another big divergence in performance over the last period of time. And you saw that starting in about 2001 after the post NASDAQ sell-off, that value and specifically high quality cash flow generating companies outperformed the quote unquote tech sector at that point pretty dramatically. And I think we're setting up for a very similar scenario over the next 3 to 5 years, where good quality companies at cheap prices are going to do quite well. And those with less proven business models that were really at extreme valuations will continue to struggle as they continue to struggle to find capital to fund their business models. So in terms of countries and opportunities, what do we see out there, and what is interesting for us? I won't touch on every region of the world, but I suffice it to say, I think there are a couple key things to keep your eye on. We think there are countries out there that have a lot of resource and a lot of protection. Canada, Brazil, for example, one's developed, one's emerging. Both are very capable of producing their own resources, and it protects them a bit from the global inflationary phenomenon we're dealing with. On the other hand, you're dealing with Europe, which has put itself in an energy deficit and is really relying on Russia. So we think these countries that have deficits are going to have to really think strategically hard about how to get out of them. We think that will be an opportunity on the investment side on one hand, but on the other hand, we think once those companies, especially Europe, finds a way to cure its energy woes, so to speak, and brings inflation back down, you are in a place where that Europe specifically will be able to perform quite nicely moving forward. However, these are not 3-month fixes. This is going to take a year or 2 years to really get through this energy crisis and then get them back into a much more competitive environment, especially with a cheap currency. So I think we'll continue to see regions really diverge. And then Asia is really going to be the most interesting place for us to watch over the next few years, specifically what is China's policy geopolitically as it starts dealing with an aging population and it starts dealing with less productivity in their workforce. Those things will cause China probably to act more aggressively moving forward. We will continue to monitor it and see how that develops, but that's something out there that I think is really important for the world to understand. So how does this all roll into what we're trying to do on the investment side, and what are we trying to think about? Again, we would expect a more challenged growth environment for the next few years. And secondarily, there's no more federal put option. We're not going to see the federal banks come in and bail us out as we see the economy slow down. They have to take on inflation. And so that federal put option, so to speak, is gone. We think we think many sectors out there, geographies will continue to face demand and margin pressure. And we think others will really be able to handle this well and certainly continue to generate cash and earn good returns for investors. And we think there's probably still quite a few earnings disappointments to come over the next year. So from our perspective, we're very focused on investing in companies that can handle this environment, that have attractive valuations, still have long-term drivers in terms of creating value for shareholders, and are able to protect themselves through their business model through some of the challenges we're facing today. And that's really where we're spending a lot of time and focusing the portfolio. A few case studies of the kinds of positions we're buying and looking at. We think there could be some problems on the consumer side and on margin side. So we want to be avoiding companies that have potential demand problems and avoiding companies that have a lot of margin risk. So the first company here is an example of a business that we think is really interesting right now, and an opportunity to buy a high quality business at a cheap price is Açaí. Açaí is a cash and carry retailer in Brazil, which effectively is similar to a Costco, except they only sell food in Brazil, and about 40% of their customer base would actually be small and medium sized businesses. The other 60% will be consumers. So think about it as the cheapest place to buy food in Brazil. And generally, you're buying it in fairly large bulk. What we love about this business is this is a management team that's been running this business for the last 12 years, has grown top line at 20%, has grown revenue at 20% a year for the last 12 years, has driven huge operating returns with 40% returns on capital through the business. It's a very, very cash generative business. And again, the cheapest place you can buy food in Brazil. So we think structurally this is a great asset and will outperform almost every other Brazilian food retailer over the coming 2-3 years. And what we think is really interesting is we're seeing a lot of companies, especially in the small cap space, that have been punished from a valuation perspective, and stocks have been hit really hard on very little negative fundamental news, or just because of the region they're trading in, or whatever it might be. And here you can see this stock sold off really aggressively in Q3 and Q4 last year, as there were Brazilian retailers fleeing, Brazilian retail investors fleeing equities and moving into fixed income. We saw a lot of concern around the Brazilian consumer in the second half of the year last year. And so we saw this stock was sold off really aggressively. We added to this position in Q1. And I think the opportunity really now is buying some of these high quality businesses at really cheap valuations. The stock was trading at under 7 times 2024 cash earnings for a business that, again, grows 20% a year and has 40% returns on capital. So from our perspective, while we understand some of the risks around temporary short-term consumer behavior in Brazil, we think this is fundamentally a consumer staple that will continue to grow share in a tough environment, and you're buying it at 7 times earnings. And we haven't seen opportunities like that in quite some time. So I think the offset to some of the challenges we face out there is really investing in these high quality businesses, again, at very cheap prices and at prices we haven't seen in quite some time. Similarly, Serco Group in the UK, which is different than the Serco in Australia. The Serco Group is a UK-based defense and public services contractor. They do some defense work, but largely they are an MRO services provider to many government sectors in the UK. This is a business that has been through a fairly large transition, but more recently, a business we've been following for quite some time, and management team we like. But at the heart of it is a very high recurring free cash flow or recurring revenue business with over 85-90% revenue visibility at the start of any given year. It has a very stable cash generating earnings stream. We were buying the stock at under 10 times free cash flow. So this is a business that historically generates very recurring cash flow streams, is being ignored by the market because it's not that sexy. It grows 5 to 10% a year. But again, trading at under 10 times earnings, and it was totally ignored by the market. Again, back to this concept of being in the small cap space. And I think names like this, and we've seen this stock start to react, which were perceived as kind of, who cares if I get 10% free cash flow, I can go buy the sexy growth story. Investors are now looking at situations like this saying, wow, I get 10% return on my cash day one. I get some growth and a very recurring business model. And I think, again, back to value starting to have its day, this is a good example for us of a business that's sitting out there in the plain wide open with no debt, very recurring earnings streams, and from our perspective, very cheap on a historic basis. So I think, I think, again, another example of the opportunities we see out there in the space we invest in that get us excited. The last company I'll talk about here is Majorel. Majorel, it operates in the consumer relationships management space, which is effectively historically was call centers, but now is a multi approach to connecting with customers, whether it's call center, text, email, whatever it is. They are your interface, your outsourced interface in terms of talking to your customers for a lot of consumer-facing businesses. What we love about this business is it's a business all over the world that's become a much better business in the last 10 years. As outsourcing has picked up, and what we have seen is as the large players have grown share here, given the increased need for technology in the business models, Majorel is the largest player in continental Europe, largest player in German-speaking Europe. And so from our perspective, what we love about this business is it's still quite underpenetrated when you look at sort of the penetration of the industry in the UK or the US. You still have quite a bit of underpenetration in Europe, but it's catching up. So quite a bit of tailwind here in terms of growth. It's the largest player in the market. And again, it came public at a point where the market was just very dismissive of business models in the second half of last year. We're buying this business at under 15 times cash earnings for a business that's growing top line 15 to 20% a year, and generating quite a bit of cash doing it. And so from our perspective, again, the concept of buying a high quality business that's being ignored by the market, given the timing, but is going to be a structural long-term winner with really no significant margin pressure today. In fact, we've seen margins go up in this business over the last 6 months. So from our perspective, we think there's a big, rich opportunity set sitting below that very expensive end of the market that investors should be looking at and thinking about, given some of the market turmoil lately, and an opportunity to really get invested in some of these high quality businesses at attractive prices. How are we positioning the fund overall, given some of the things I've said? Historically, the portfolio construction is fairly consistent. We're typically going to be about 5% cash, around 40 positions, 40 to 50 positions. Generally, the top 10 positions are going to be 30 to 40% of the book. And we will typically have, we have a 2 to 5 year time horizon when we make an investment. And you'll see us have a fairly diverse set of sectors and geographies within the portfolio. Here, the market cap says mean market cap of under 3 billion. We tend to skew quite a bit smaller than the index. Our median market cap typically balances between 1 to 1.5 billion. So we're significantly smaller than the index itself. What you'll see from a sector and a market cap basis, what I was just saying, is you tend to see us overweight things like information technology, consumer staples, discretionary, industrials, places where we think you can create those business models that have long-term returns on capital, and would typically be underweight businesses places where we think it's harder to find business models that have long-term competitive advantages. On the bottom of the slide here, you can see what I'm talking about in terms of us being quite overweight that sub $1 billion market cap space, where we really think it's a rich opportunity set. We've seen, certainly in the last 2 months, the liquidity, certainly the lack of liquidity in the small cap space has caused these names to sell off dramatically. And so from our perspective, there's a big opportunity in that sort of sub $2 billion space right now to buy very attractive businesses at cheap prices. That's really one end of the market that we've seen hit hard by this turmoil, which we think will rebound quite nicely coming out of it. And on a regional basis, I think you can see here, we are quite a bit overweight Europe, given the valuation disparity discussed before, and the opportunity set we think that comes on the back of Europe fixing some of its energy issues. And again, we are quite a bit underweight the US, given the expensive currency as well as the relatively expensive equities against the rest of the world. And so that's how the fund is positioned. But really the focus, and when I look at the book itself, and I think this is really interesting, is that we focus on high quality businesses. And so what you can see here is currently our book is trading at about 14 times 2022 earnings versus the index at about 15 times, which isn't a huge disparity. But I think what's really compelling is if you look at the return on equity, our portfolio has a weighted average return on equity of almost 30% versus 11% for the index. And it's trading a net debt to EBITDA of only 1.5 turns versus 3.3 for the index. And so you're getting a growing group of companies with very high returns and very little leverage at under 15 times earnings, and that is the cheapest we've seen our portfolio in quite some time. So again, you're able to put together, and I think the trade-off for that is really on buying a smaller cap book at this point. So from our perspective, the opportunity set to buy these small companies at cheap prices, but very high quality companies that are going to compound value for you is quite good right now. And I think that's reflected in the current valuations as you see them in the portfolio. And again, what we're focused on is core positions are attractively valued, high quality businesses that are going to compound over long periods of time. They have stable balance sheets, and they're going to be able to withstand a lot of the turmoil we see out there right now. And then I think we're really focused on seeking to avoid companies that face a lot of margin pressure, certainly in the near term, as you see inflation across a lot of supply chains. And the second thing we're seeking to avoid is demand destruction. As we start to see the economy slow down with higher interest rates, we would very much expect to see there a lot of places with some demand destruction, parts of consumer discretionary, parts of the industrial complex, that we would want to seek to avoid companies where we think we could have big revenue issues as you get into this demand downturn. So that is at a high level what we have been up to and what we have been focusing on from an investment standpoint. We hope that's been helpful because there's a lot going on geopolitically and economically. But we do think there is an interesting opportunity set developing in the small cap value space specifically. So I'll stop there. I'll open it up to Q&A, and I thank you all for your time this morning.
Thank you, John. That was great. We've had a few questions come through, so we'll just get started with those. So you mentioned in the presentation the value disparity between the US and the rest of the world, including Europe. It's quite obvious, as we can see. What are the things you think need to happen to help close the valuation gap and allow non-US equities, especially European equities, to outperform?
So that's a great question. And I think what we really need to see, so for those of you who don't know, Europe is currently at a reasonably significant energy deficit, and they're forced to import quite a bit of natural gas from Russia due to some decisions post the Fukushima tsunami back in 2011. Europe, specifically Germany, actually accelerated the closure of some of the nuclear facilities, which has left them in a fairly big energy deficit, which means they're very reliant on Russian natural gas. I think the two outputs from that are, one, Europe will only be so aggressive with Russia as this war plays out, and can only be so aggressive with Russia because they are relying on that natural gas. But I think more importantly, what we need to see is Europe become energy independent again. And I think that would be a big driver of a much more competitive manufacturing environment in Europe as cost of energy came down, and also give investors quite a bit of confidence that these geopolitical issues won't impact company fundamentals. And so I think you're seeing Europe start to take a coordinated effort at solving this problem. While I think the solution will take a year, 2 years, 3 years, I think investors will start to gain confidence as they start to see the plans of energy independence as more credible. So whether it's natural gas being transported in from North America or Middle East, or Europe looking at different solutions, which I don't think will just be solar or wind, but I think we need to be multifaceted. As investors gain confidence that will be a concerted effort to really solve this energy independence issue, I would expect investors to start getting more confidence behind Europe, especially the growth of Europe, as we see that solution form. So I think that's really the critical driver for me in terms of investors believing that Europe is going to solve this issue. And I think that will be a catalyst for a lot of European equities.
Excellent. Just following on from that, so if the energy situation in Europe does unfold as you predict, what are the investment opportunities for the portfolio? You mentioned manufacturing. Would it also prompt you to make any changes to the portfolio based on the current holdings?
There may be some idiosyncratic opportunities that present themselves from a company basis. So we may see some infrastructure businesses start to develop that help transport natural gas from North America to Europe and the like. And we would always be looking at investing in those companies that do the picks and shovels. So we will be looking at those opportunities. But by and large, I think we are quite happy with the way the book is positioned in Europe specifically, as we think a lot of the beneficiaries of this, will not only be obviously the very specific opportunities that are around this energy infrastructure, but more importantly, it will be very critical for the entire manufacturing complex in Europe to become more competitive. And we think if you pair a more competitive energy cost with a relatively cheap currency vis-a-vis the US, you start to look at a lot of companies in France, UK, and Germany that have been competing, fighting sort of an uphill battle, begin to fight a downhill battle, and things will get a lot easier for them. So I don't think there will be any large wholesale changes in our portfolio. I think we're frankly quite well positioned for that outcome. But I think we don't know. I think the question is more on timing. But so one or two idiosyncratic opportunities may present themselves, but more than anything, we see the portfolio is already fairly well positioned for that type of scenario.
Yeah. The next question, it's more around the tech exposure in the portfolio. So we can see that your exposure is at about 30%. How is this possible? What are you thinking around tech, given that your value orientation?
Yeah, absolutely. So, I think I want to be clear about this, which is, obviously investing in the small cap space, you get some anomalies in terms of how business models are identified and what sector they're put in. But generally speaking, when we are looking at our tech exposure, we are buying generally service-based industries that have very high recurring revenue streams that would be at the boring end of the tech world, so to speak. And so from that perspective, we own a value-added reseller in Canada, and a UK business which effectively hires is more of a staffing agency. And so from our perspective, we think there's a chunk of the tech companies we invest in, we think have very high returns on capital and are quite cheap. But I would say they're very much outside of that growth capital bias that we see in the market. So while we do have exposure to tech overall because of the high quality businesses that tend to populate that universe, we do think when we look across our tech book from a valuation perspective, and I think it shows up in the overall portfolio statistics, our book is trading at under 14 times earnings, and we really don't have high levels of exposure to anything we'd be concerned about, which would be one, valuation of that really growth end of the spectrum and those businesses that haven't really shown proven business models yet, and two, we don't think we have significant exposure to supply chain issues in our tech holdings. So I think those would be the two concerns we have, but overall, we still think it's a very attractive place to find good businesses with businesses with very good business models that will be able to compound over time.
Just staying on the valuation point, are you seeing valuation gaps so what sort of valuation gaps are you seeing between large and small caps within the regions that you're focusing capital on? Are you seeing this as a potential tide change for small caps? We always talk about valuation disparities between large and small. And
so I think what we have seen specifically in sort of this last quarter or two, and it's been more severe in this last quarter, is that small caps, because that's where we've seen liquidity come out of the market, right? And I think that's really triggered some fairly significant moves in small cap equities. So you're having global small caps. I would have to look at stats, and I don't have them in front of me, but you having stocks get marked down 20, 30, 40% on really no fundamental news. And that's not happening in sort of that mid and large cap space. And so from our perspective, that's sort of the thing out there in the market that people aren't talking about as much. We know tech is sold off really hard, but people aren't talking about how much small cap is sold off. And so while on a micro basis, and again, we focus on company specific, on a micro basis, I look across our book and we're buying small caps, sub-billion-dollar companies at under 10 times earnings. And I wouldn't say that's an aggregate number across the world, but I do think when you look at that small cap space, it is quite cheap and quite attractively priced. And I do think there is a pretty big gap when you start looking at market caps and valuations right now. And I think that happens in most downturns, right? You see small caps sort of blow out first, sell off first, and then also as they recover the most violently. And so from the cycles we've been through before, this is really no different. We think the small cap space is quite cheap on a relative basis right now because of that phenomenon, that liquidity is just dried up in the space, and you're seeing certain stocks really get marked down because of it.
glad someone asked this. India is one of the regions that you considered better able to weather inflation. Just out of curiosity, do you have any investments there?
We just exited one of our investments in India. That was the only investment we had in India at that point. So we've actually, from our perspective, India is a very interesting place to invest. It's got a lot going for it in terms of companies with very high returns on capital. Should be good demographics and good growth over time. There continue to be some pretty significant infrastructure concerns in India. They still have a lot of energy issues and just the infrastructure overall isn't supportive to business formation. But that being said, we are absolutely, India is a place for us with a lot of opportunity. However, it is a place that we've seen valuations pretty extended for a long period of time. So we've taken a fairly cautious approach in India. That is starting to change. India sold off pretty hard along with everything else in the world. And so we would expect to continue to find opportunities in India. And I think from a long-term basis, we think India has a lot of opportunity for investors if they are willing to do their homework, because it is a market fraught with governance issues and some other challenges. So it takes quite a bit of diligence, but we do think there are some interesting opportunities start to present themselves in India.
Well, we've got time for one or two more questions. Fairly interesting one. Performance seems to be turning around in the last month. Are there any specific reasons for this? Obviously, do you see it continuing? That's the question everyone's asking.
No, I think it's a good question. So I'll answer that question briefly, which is one, US dollars, we obviously would have a lower allocation to US dollar, which has been moving up aggressively the last 6 months and started to turn around more recently, which benefits our portfolio. But I think more critically, when you look at kind of the attribution for our portfolio, and I would just highlight selection versus allocation. Selection means how are we doing at stock picking? Allocation means were we in the right places? What we have seen is sort of from a sector basis, the things that impacted us, energy and materials have performed quite well in the last 12 months, where we have very little exposure, just given our focus on business models. You also see kind of Europe being a headwind for us from an allocation perspective. And then lastly, and most important, a massive allocation issue with the sub sort of $1 billion space, right? So that means the sub $1 billion portion of the market has really underperformed the rest of the market. And so what we've seen the last month is sort of a bottoming in that small cap space and a bottoming of non-US equities. And then the US dollar started to weaken. And as those things start to bottom and rally, those would obviously be, sort of big drivers of relative performance for our fund. So we do think ultimately those things reverse themselves over time. But the headwinds we have been facing, certainly in the small cap specifically, or in a regional basis, and then a sector basis, have all started to reverse a bit this month. And we think, again, that portfolio, as those things reverse, the portfolio will benefit on a relative basis from all of those things beginning to reverse. And so we've seen a little bit of it this month, but we think, we're never sure if it's this month, next month, or 3 months, but we think all of the things we're invested in certainly have the potential to have quite a bit of tailwinds on a relative basis because of how much they have sold off over the last 3 to 6 months.
Look, in the interest of time, I'm going to have to wind up the Q&A now. Thank you, everyone, for joining us. Just really want to iterate that this is a very differentiated strategy. So we should expect different performance from a portfolio construction perspective. Differentiation is always a feature we aim to incorporate or achieve. On a benchmark relative basis, the fund has experienced some headwinds, as John has discussed, because of their underweight position in the US, which means they have missed out on the US dollar rally. However, the stronger US dollar will also increase the competitiveness of non-US manufacture, and American consumers will be increasingly incentivized to source goods offshore. In closing, I hope that you get the sense that the portfolio is in good shape and that whilst the sell-off has been challenging, signs of value are starting to emerge. If you would like to discuss the fund or you have any questions about the Global Small Companies Fund or any of our other funds, please get in touch. We'd love to hear from you. Thank you and have a great day.